The American auto industry is going through one of its most turbulent periods in decades, and at the center of the storm are Ford and General Motors. Both companies entered the electric vehicle race with lofty promises and aggressive targets. But the reality on the ground is proving far more complicated than their executives or investors imagine. Instead of becoming the undisputed leaders of a new era of clean mobility, Ford and GM are burning through billions of dollars, losing ground to competitors, and making drastic cuts that have left workers, dealers, and customers questioning whether the transition to EVs has been miscalculated. The story of Ford's struggles is one of ambition colliding with economic reality. When the company announced its plans to become a major player in the EV space, it expected that the market would grow quickly, that customers would pay premium prices for high-tech electric trucks and SUVs, and that government support would smooth the road ahead. Instead, sales have fallen short of expectations. Costs have ballooned and profits have evaporated. Ford's electric vehicle division, which was supposed to be its growth engine for the future, has turned into a financial black hole. In 2024 alone, Ford's EV unit lost more than $5 billion, and projections for 2025 suggest those losses will rise even higher. On a per-vehicle basis, Ford has admitted it loses tens of thousands of dollars for every EV it sells. At the same time, Ford's traditional gas-powered vehicles remain the backbone of its business. Pickups like the F-150 and SUVs like the Explorer and Bronco continue to generate profits, while the electric versions of these models stumble. The much-hyped F-150 Lightning, hailed as a game-changer when it debuted, has fallen sharply in sales. Production has been halted more than once due to slow demand, and dealers who once clamored for allocation are now refusing shipments because unsold trucks are piling up on lots. Similarly, the Mustang Mach-E, once touted as Ford's answer to Tesla, has seen sales collapse year over year, with inventory swelling and customers showing little interest despite price cuts and incentives. Ford's leadership has responded with a mixture of cost-cutting and long-term bets. On the one hand, it has scaled back its EV investments, delayed the launch of several new models, and trimmed battery plant projects that were once central to its electrification roadmap. On the other, it continues to insist that the EV transition is inevitable and has announced plans to reinvent its manufacturing process for a new wave of cheaper electric vehicles later this decade. One of these projects is a small electric pickup, slated for 2027, that the company hopes will retail at around $30,000, roughly half the average EV price today. Ford's CEO Jim Farley has even compared the effort to the Model T revolution, promising that the company will crack the code of mass-market EV affordability. But investors and analysts remain skeptical, pointing out that Ford has yet to prove it can sell electric vehicles profitably or in the volumes necessary to justify such optimism. General Motors, meanwhile, faces its own crisis, one that may be even more severe. Under CEO Mary Barra, GM has spent years promising to lead the all-electric future, going so far as to declare that it would phase out internal combustion engines entirely by the mid-2030s. Yet the company has struggled mightily to translate those promises into reality. Its EV rollout has been plagued by delays, production shortfalls, and lackluster demand. GM initially pledged to build 400,000 electric vehicles by mid-2024, but it quietly abandoned that goal after realizing demand simply wasn't there. By the third quarter of 2023, the company had produced just over 30,000 EVs, far below what it had advertised, and sales grew at a slower pace than production, signaling that inventory was piling up rather than moving off dealer lots. The company's most important electric launches, the Chevrolet Silverado EV and GMC Sierra EV, have both been delayed until at least late 2025, leaving General Motors without competitive entries in one of the most lucrative vehicle segments. Even the Chevrolet Bolt, once GM's most affordable and highest volume EV, has been discontinued, leaving a gap in the lineup that won't be filled until its replacement arrives years from now. In the meantime, GM has shuttered plants, laid off workers, and cut back on expenses in an attempt to satisfy nervous shareholders. More than 1,000 employees lost their jobs in a single week as production of the Bolt wound down, and thousands more face uncertainty as the company restructures its factories for a future that seems increasingly out of reach. Adding to GM's woes is the implosion of Cruise, its autonomous vehicle subsidiary. Once billed as a potential cornerstone of GM's future business, Cruise has become a liability after a series of high-profile failures. Following a tragic incident in which one of its driverless cars struck and killed a pedestrian, Cruise suspended operations nationwide, top executives resigned, and layoffs swept the division. What was supposed to showcase GM's technological edge has instead highlighted its vulnerability, adding another layer of financial strain and reputational damage at the worst possible time. The market reality for both companies is that customers remain reluctant to adopt EVs at the scale automakers expected. While early adopters and luxury buyers continue to support electric models, mainstream consumers have been slower to follow. Surveys show that many Americans remain concerned about charging infrastructure, range anxiety, and high sticker prices. The average EV still costs nearly $60,000, far above what most middle-class families can afford. Hybrids, by contrast, are thriving, offering the efficiency benefits of electrification without the charging headaches. Hybrid sales have soared while EV sales growth has slowed. In fact, nearly half of EV buyers are now trading in their vehicles for hybrids, preferring the balance of convenience and cost. Toyota, long criticized for dragging its feet on pure EVs, is now being praised for doubling down on hybrids, which have captured the bulk of the electrified market. For Ford and GM dealers, this shift has been devastating. Many were forced by corporate mandates to invest heavily in EV certifications, charging infrastructure, and showroom upgrades, sometimes spending more than $1 million just to keep their franchises eligible to sell electric vehicles. Now, those same dealers are stuck with unsold inventory, reluctant customers, and financial pressure from investments that may never pay off. Some have begun refusing additional EV shipments, an almost unheard-of reversal in an industry where dealers traditionally fight for every unit they can get. The political backdrop adds further complexity. The Biden administration has set aggressive emission standards that effectively require automakers to electrify a majority of their fleets by the early 2030s. In theory, these policies are designed to accelerate the EV transition and reduce carbon emissions. In practice, they are forcing companies like Ford and GM to push vehicles into a market that isn't yet ready to absorb them. Critics argue that car makers are listening more to regulators than to customers, building products that satisfy political mandates but not consumer demand. If this misalignment continues, the industry could face even greater financial strain as billions are poured into vehicles that buyers simply don't want. The human cost of these strategic missteps is already evident. Thousands of auto workers have been laid off as plants are retooled, product lines are delayed, and strikes disrupt production. The United Auto Workers strike in 2023 alone cost GM nearly $1 billion and left Ford with a dent of over $1.5 billion. Even after new contracts were signed, higher labor costs added nearly $1,000 to the price of every vehicle the companies produce, squeezing margins further in an environment where EVs are already unprofitable. For the men and women on the factory floors, the promise of stable jobs building the cars of the future feels more like a gamble than a guarantee. So, are EVs a scam, as some critics have suggested? Not exactly. The technology is real, and electric vehicles do offer significant environmental and performance advantages. But the rollout has been mishandled, expectations have been inflated, and the economic challenges of building and selling EVs profitably have been underestimated. Tesla, the pioneer in the space, has shown that EVs can sell, but even it has faced slowing demand, price cuts, and margin compression. The states that once led in EV adoption are now seeing the slowest growth, suggesting that the early adopter wave has crested and the harder task of persuading the mainstream is just beginning. For now, the story of Ford and GM in the EV era is one of growing pains, costly miscalculations, and a marketplace that refuses to bend to corporate will. Whether they can survive this upheaval and emerge stronger, or whether they will cede the future to more nimble competitors, remains one of the biggest open questions in the global auto industry. What's certain is that the dream of an effortless transition to electrification has collided with reality, and the road ahead for America's biggest automakers looks rougher than ever.